Ladies and gentlemen, archivist here. I want you to glance at your watch. Last night, while New York was asleep, while London was still pouring its first cup of morning coffee, and while the algorithms that operate the global financial system were running in low-power mode, something occurred in Tokyo that should not exist in a mathematically stable system. We are constantly told that the U.S. Treasury market is the ultimate risk-free asset. We are told it is the deepest, most liquid, most pristine pool of capital on Earth. We are told that you can unload $1 billion of U.S. debt in a millisecond, and the market will not even flinch. That belief is the lie that holds the Western financial world together. Last night, at exactly 2 a.m. Eastern Standard Time, that lie was exposed. A sell order slammed into the computerized ledger of the U.S. Treasury market. This was not routine rebalancing. It was not a hedge fund taking quarterly profits. It was not a fat finger error, no matter how desperately Bloomberg is trying to sell that explanation this morning. It was a block trade of $50 billion in 10-year U.S. notes. And for exactly 11 seconds, there were 0 buyers. The screen went black. The bid vanished. The algorithms designed to buy every dip simply shut down. For 11 seconds, the value of the global reserve asset was effectively undefined. Now you may be thinking, archivist, it was only 11 seconds. The market recovered. Why does this matter? It matters because in high-frequency trading, 11 seconds is an eternity. It is the difference between a glitch and a cardiac arrest. If you were a human trader sitting at a desk in Singapore or Hong Kong last night, you witnessed something you're never supposed to see. You saw the bid stack, the wall of buy orders that protects the US dollar, evaporate. You saw an air pocket. And when the price finally reappeared 11 seconds later, the yield on the 10-year Treasury had jumped 14 basis points in a single tick. That is a 4 standard deviation event. That is a black swan on a Tuesday. The mainstream media is already spinning the story. They are calling it a liquidity hiccup. They are blaming a software update. They are assuring you that order has been restored. They are lying. What you saw last night was not a glitch. It was a rejection. It was the moment the United States lost its buyer of last resort. Because we know who pressed the button. We examined the custodial flows. We tracked the collateral movements from foreign official accounts at the New York Fed. The seller was not a bank. The seller was not a chaotic emerging market. The seller was Japan. And that, ladies and gentlemen, changes everything. To understand why a $50 billion sale from Tokyo marks the beginning of the end for the current financial order, we have to go back in time. We have to revisit the grand bargain forged in the ashes of World War II and solidified in the 1980s. For 40 years, Japan has served as the loyal vassal of the American financial empire. It is a harsh description, but it is the forensic reality. When the United States runs deficits, when it spends money it does not have on wars, welfare, and bailouts, it issues debt. Treasury bonds are printed and someone has to buy them. For decades, Japan was that buyer. They ran trade surpluses. They sold us Toyotas and PlayStations. They received dollars in return and faithfully recycled those dollars back into U.S. debt. They now hold $1.1 trillion in treasuries, making them the largest foreign holder of U.S. debt on Earth. Larger than China, larger than the U.K. They were the anchor. When the world panicked and sold, Japan held. When the U.S. needed lower rates, Japan bought. They absorbed American inflation. They financed American wars. They suppressed their own currency to keep the dollar strong and the U.S. consumer happy. But last night, the vassal rebelled. They did not merely sell bonds. They initiated a collateral substitution. They examined their balance sheet. They looked at a collapsing yen. They looked at surging energy import costs. And they made a cold, calculated decision. Saving the Japanese yen mattered more than saving the U.S. Treasury market. This is the fracture point we have warned about on this channel for 6 months. We told you the pain would eventually become unbearable. We told you self-preservation always overrides alliances. Last night at 2 a.m., the Bank of Japan effectively told the Federal Reserve, "We are full. We are not buying anymore. In fact, we are selling." Now let's examine the forensics of the trade, because the timing is the smoking gun. Liquidity behaves like a tide. It rises and falls. At 2 a.m. New York time, the tide is at its lowest. U.S. banks are closed. London is barely waking up. Market depth is razor thin. If you are a friendly ally trying to help the U.S., you sell at 10 a.m. when buyers are abundant. You do not sell at 2 a.m. Selling at 2 a.m. is hostile. It is designed to inflict maximum damage as fast as possible. It is a message. Japan is signaling desperation. The yen has been trading at historic lows, 160, then 165, then threatening 170 to the dollar. At 170, the Japanese economy breaks, energy prices double, food prices explode, the ruling party faces political annihilation. The Bank of Japan had no choice. They had to intervene. They had to buy yen. And to buy yen, they had to sell dollars. Their only trillion-dollar dollar pile sits in U.S. Treasuries. So they sold. They dumped $50 billion into the thinnest market of the day, fully aware it would cause a flash crash. They sacrificed the American bond market to save their own currency. And here is the terrifying part. It worked. For several hours, the yen strengthened. The bleeding in Tokyo stopped. But the bleeding in the global financial system has only begun. Because that 11-second freeze was not technical. It was systemic trust evaporating. Think about the implications. If Japan, the safest, most loyal holder of U.S. debt, is dumping $50 billion blocks overnight, who is safe? What happens when China sees this? They hold $700 billion. Do they calmly sit, or do they rush for the exit? What happens when hedge funds see this? We are staring at a liquidation cascade. The no-bid event proved there are no buyers at these prices. The Federal Reserve is doing quantitative tightening. Commercial banks are already full. So when Japan sells, who buys? No one. That is why yields spiked. That is why the heart monitor flatlined. And the timing could not be worse. The U.S. Treasury must refinance $9 trillion in the next 12 months. They need buyers. They need Japan. But last night, Japan threw the checkbook away. If Japan becomes a net seller, supply overwhelms demand. Bond prices collapse, yields explode. A 10-year Treasury at 6% or 7% freezes housing, bankrupts banks, and triggers a doom loop. Japan just tipped the first domino. But there is something darker. Hidden beneath the chaos was another mechanism quietly activating. A mechanism linking the yen, the dollar, and equities in a deadly triangle. This is not just about bonds. It is about the carry trade. And last night, Japan tripped the wire on a financial guillotine hanging over Wall Street. At 2:05 a.m., while bonds froze, S&P 500 futures plunged 40 points in a vacuum. Why? Because everything is connected by the yen carry trade. And if this analysis is correct, the $50 billion sale was not the crisis. It was the margin call. We are not witnessing a bond tantrum. We are witnessing the opening move of a global margin call. And this is only the beginning. They behaved like a subprime borrower signing an adjustable rate mortgage because the teaser rate looked cheap. Well, the teaser rate has expired. Over the next 60 days, peaking specifically in March, a massive wave of short-term U.S. debt matures. Roughly $9 trillion of our U.S. debt must be refinanced over the next 12 months. The U.S. Treasury has to enter the market and sell $9 trillion worth of bonds simply to remain solvent. They are not raising money to build roads. They are not funding hospitals. They are raising cash just to keep the lights on in the White House. Now imagine you are Janet Yellen. You are standing in front of a $9 trillion debt wall. You need to sell. You must sell. You scan the room for buyers. Normally, sitting in the front row is Japan, holding a massive checkbook. Sitting beside them is the Federal Reserve, printing money. Sitting beside them are the U.S. banks. But today, the seats are empty. The Federal Reserve is engaged in quantitative tightening. It is selling, not buying. The banks are insolvent, clogged with bad commercial real estate loans. And Japan stood up, flipped the table, and walked out of the room. This is the funding cliff. When you have $9 trillion of supply and zero strategic demand, price discovery turns violent. We saw yields touch 4.5% last week. But without Japan, the natural rate of the U.S. 10-year Treasury is not 4.5%. It is 6%, maybe 7%. You might ask, so what, archivist? Rates go up? Who cares? The math cares. Let me introduce the concept of a fiscal heart attack. The United States currently generates about $4.9 trillion in annual tax revenue. Before this crisis, we were already spending roughly $1.1 trillion per year just on interest payments. That is more than the entire defense budget, more than Medicare. And that $1.1 trillion interest bill was calculated at an average interest rate of around 3%. If Japan exits and rates reprice to 6%, the interest bill does not rise modestly. It doubles. At $2.2 trillion in interest payments, nearly 45% of all U.S. tax revenue would go solely to paying bondholders. Think about that. Almost half of every tax dollar would service debt. No money for the military, no money for Social Security, no money for government salaries. This is called fiscal dominance, the mathematical moment where a currency dies. The bond market understands this. The bond vigilantes smell blood. They know the United States cannot survive at 7% interest. They know the system breaks around 5.5%. So what happens next? We enter the no-win scenario. The Federal Reserve has two choices, and both end in disaster. Choice A, hard default, rates rise to 7%. The U.S. government enters a brutal austerity spiral. Spending is slashed. Promises are broken. The economy collapses into a depression-style deflation. Politicians will never allow this. It is political suicide. Choice B, soft default through yield curve control. This is the path of least resistance. The Fed sees a failed auction. They see Japan leaving. They see yields racing towards 7%, and they panic. They announce, We will buy the bonds. We will be the buyer of last resort. They restart the printing press. They create trillions of dollars to absorb the unsold debt. They pin rates at 4.5%. This saves the government, but it murders the dollar. If the Fed prints $9 trillion to absorb the debt wall, inflation does not settle at 3%. It surges to 15%, maybe 20%. This is 1970s-style stagflation. On steroids, this is the liquidation of the US dollar. Japan understands this. That is why they are selling now. They are front-running choice B. They know the US must print. They know the dollar will be diluted to save the Treasury, so they are dumping dollars before the presses start. They're exchanging a depreciating asset, US debt, for hard assets, gold, commodities, domestic infrastructure. What we witnessed last night was not just yen defense, it was a vote of no confidence in the solvency of the United States. Japan has seen the debt wall, they ran the numbers, and they realized the US Treasury is a subprime borrower wearing a Gucci suit. So where does that leave us? We are trapped in a burning building. The fire exit, Japan, is locked. The sprinkler system, the Fed, is filled with gasoline-grade inflation, and the debt wall crashes down in less than 60 days. Markets are still in denial. Stocks are praying for a Fed pivot. They believe rate cuts will save them. They don't understand that a rate cut caused by a failed auction is not stimulus. It is a panic signal. It means the sovereign itself is distressed. When the sovereign breaks, everything priced in that currency breaks with it. This is the end of the 60-40 portfolio. This is the end of passive investing. You cannot hide in the debt of a bankrupt nation. So, if bonds are toxic, cash is about to be debased, and stocks are vulnerable to forced liquidation, where do you hide? Is there an asset with no counterparty risk? An asset that floats when the Treasury ship sinks? Japan is buying it. China is buying it. Central banks are hoarding it. Yet the average American has zero exposure. In the final section, I will give you the archivist's protocol. Not just buy gold, you need structure. You need positioning for yield curve control. I will outline the 3 assets that historically survive sovereign debt crises, and I will give you the Japanese hedge, a specific trade designed to profit from the chaos in Tokyo. The wall is falling. It is time to move out of the blast zone. We have spent the last 15 minutes dissecting the crime scene. Japan dumped $50 billion in treasuries. The carry trade guillotines sliced through the AI bubble. And the $9 trillion debt wall looms over March. The diagnosis is clear. The risk-free rate is no longer risk-free. The loyal vassal has exited. The United States is entering a sovereign debt spiral. Now, the time for analysis is over. The time for positioning is now. Most investors sit in the so-called 60-40 portfolio. 60% stocks, 40% bonds. That model assumed bonds protect you when stocks fall. In 2026, bonds are not the shield. They are the weapon. If you own a 30-year treasury today, you are not investing. You are bag holding. You are locking capital into a currency about to be debased at mathematically insolvent rates. You need a war portfolio. Protocol 1, the duration purge. Cash is king, but only briefly. Never trust long promises during a sovereign crisis. Long-dated bonds will collapse as yields explode. Exit the long end. Move to 3-month T-bills and overnight liquidity. Stay mobile. Protocol 2, the hard hedge. Gold, Bitcoin, fixed-rate debt, assets that cannot be printed. Let inflation destroy the liability while preserving the asset. Protocol 3, the yen pincer. A strengthening yen destroys Japanese exporters. As Japan defends its currency, the Nikkei collapses. This is the inverse carry trade, the pressure point of the unwind. We are entering a period future textbooks will study for a century. Pax Americana ended last night at 2 a.m. Not with a crash, but with 11 seconds of silence. A no-bid moment. Ignore the spin, ignore the reassurances. The debt wall is 60 days away. The machine is broken. You have a choice. Stay in the burning theater or find the exit. This is Archivist. The bond market is closed. Class dismissed.